Hi everyone, Demir here from Westmount Wealth Management. Let's start with a simple truth about magic. A magician never explains the trick while they're performing it. Because the moment you know where to look, the illusion simply disappears. What felt mysterious becomes mechanical. What felt impressive becomes rather obvious. Dividend investing works much the same way. The appeal is immediate. Cash shows up in your account. The portfolio feels productive. You are being paid for owning stocks. Price swings fade into the background while income takes center stage. It feels disciplined, conservative, even safe. But like all good magic tricks, the trick depends on where your attention goes. While investors focus on the dividend, the real action is happening somewhere else. Here's the part that most people miss. A dividend is not a reward created by the market. It's a transfer. Cash leaves the company and shows up in your account, and the value of the company adjusts accordingly. Nothing new is actually being created. Wealth is simply being rearranged. This is not an opinion. It is basic corporate finance. Decades ago, Miller and Modigliani showed that a company's value comes from its earnings power and its investment decisions, not from whether it pays dividends or keeps cash inside the business. The business is what actually matters. The wrapper doesn't. And yet, dividends feels rather different. The difference is emotional, not economic. Receiving income feels like progress. Selling shares feels like depletion. One feels responsible, the other feels pretty reckless. But when you take a step back and you look at total wealth, both are basic ways of funding spending from the exact same pool of capital. Consider a simple example. An investor with $1 million needs $40,000 a year. One portfolio yields 4% and delivers that income automatically. Another one yields 1%, and the investor sells shares to make up the difference. At the end of the year, both investors have funded identical levels of spending. Both portfolios are smaller by the exact same amount. The only real difference is how the transaction felt. Feelings matter because behavior shapes outcomes, but feelings shouldn't be confused with safety. The deeper illusion is the belief that dividends themselves are stable. They are not. Dividends are discretionary. They are paid at the pleasure of the board. When conditions deteriorate, companies protect balance sheets before they protect payouts. History makes this pretty clear. During the global financial crisis, dividends fell sharply across markets. In the early stages of the pandemic, cuts and suspension reached levels not seen since 2009. Income that felt pretty dependable disappeared precisely when investors needed it the most. There's another consequence of dividend preference that's easier to miss, but often it's more damaging. Dividend strategies quietly reshape portfolios. High dividend-paying portfolios tend to cluster in the same sectors, so financials, utilities, real estate, consumer staples, and energy. These sectors support higher payouts, but they also share similar economic sensitivities, exposures to interest rates, regulatory risks, amongst other factors. What looks diversified on the surface can become rather concentrated underneath. You can see this clearly by comparing two well-known ETFs. The iShares Core S&P 500 ETF simply owns the market as it exists. Its largest weights reflect where earnings power has accumulated, with technology, financials, consumer discretionary, and healthcare playing leading roles. A high dividend version of the same index looks rather different. Real estate, utilities, consumer staples dominate. Technology barely registers. That difference has mattered. Over the past 10 years, ending in late 2025, the broad market ETF delivered annualized returns in the mid-teens. The high dividend version lagged meaningfully, even with dividends being reinvested. Over shorter periods, that gap has remained. Look, this is not a prediction that technology will always lead, not by any stretch of the imagination, nor is it an indictment of dividend-paying stocks. It is a reminder that dividends are characteristics, not a return engine. A dividend tilt is not a neutral income choice. It is a sector bet, and sector bets can be rather expensive. The evidence reinforces this. Academic research consistently shows that long-term equity returns are driven by exposure to factors like profitability, value, and size, not by dividend policy. Dividends often correlate with these traits, but they're not the source of return. They are a byproduct of how companies allocate capital. When investors chase the byproduct and ignore the source, they misunderstand what actually compounds. Look, none of this means that dividends are bad. They can be useful. For some investors, regular income provides structure and emotional comfort. For others, dividends simplify cash flow management. Those benefits are real. But dividends are a tool, not a principle. At Westmount Wealth Management, income is designed, it's not outsourced. We start with spending needs, time horizons, and tax considerations, and then build portfolios to support those goals. Sometimes dividends play a role. Sometimes systematic withdrawals make more sense. Often it's a blend of the two. The objective isn't to avoid selling assets, it's to avoid selling the wrong assets at the wrong time for the wrong reasons. Safety in investing is not yield. It is alignment. Alignment between your assets and your liabilities, between cash flows and commitments, between portfolio behavior and human behavior. The magician trick works because the audience watches the flourish and ignores the mechanics. Dividend investing feels safe because the cash payment is visible while the price adjustment is pretty easy to ignore. But wealth is not built on what feels good in the moment. It is built on what compounds over long periods of time. Dividends do not create return. They rearrange it. Once you see that, the illusion fades and attention shifts to what actually matters. Total return, diversification, discipline, and a plan designed to endure when markets and emotions inevitably misbehave. Thanks for watching, and as always, if you have any questions, you know where to find us.